Now we are going to use the daily closing prices of the futures contract in order to calculate the profit and loss, and this is known as the daily settlement price. So from 1st to 30th of March, we are going to use the closing prices of the futures market in order to calculate the daily profit and loss. Let's say our contract is going to expire on 31st of March. So long futures, short futures, we have a Nifty futures contract and that is going to expire on 31st of March. When we do the final calculation of profit and loss, that means on 31st of March, when we are going to do the profit and loss calculation, instead of taking the closing futures prices, we are going to take the closing price of the spot market. And this is known as the final settlement price. So let's see an example. Our futures contract is expiring on 31st of March. Let's say two people are taking a position on 30th of March. So 30th of March, let's say the Nifty is again 18,000 base value. Very easy to calculate the initial margin and maintenance margin. So you already know how did we arrive at 90,000 and 72,000. On 30th of March, when we are calculating the profit and loss, we are going to take the closing futures price. On this day, let's say the futures price closing was 17,950. So from 18,000, the market has come down to 17,950. So actually it has come down by 50 points. So market has come down by 50 points. The short is earning 50 multiplied by 50, which is 2,500. 90,000 plus 2,500, his account is having now a balance of 92,500. The long is losing 50 points. 50 multiplied by 50 is 2,500. So 90,000 minus 2,500, his account is now having 87,500. On 31st of March, when we are going to do this calculation, instead of taking the closing futures prices, we are going to take the closing spot price. So because the futures contract is going to expire on this day, to do the final calculation, we are going to take the 31st March closing spot prices. So let's say the spot market is closing at 18,070. So yesterday the market has closed at 17,950. Today it has gone up by 120 points. So if the market goes up, it is going to benefit the long. The long is going to make 120 multiplied by 50, which is 6,000. So from 87,500, we are going to deposit 6,000. His account is now going to have a closing balance of 93,500. The short is going to lose 120 multiplied by 50, which is 6,000. So this money will be reduced from his account. 92,500 minus 6,000. His account will now have a balance of 86,500. The contract has expired over here. So the contract is not reset. The contract has expired. So only for this final date calculation, you are going to use the closing spot prices, and this is known as the final settlement price. So I hope the difference is clear. When we are doing the calculation on 30th of March, we are going to use the closing futures prices. This is known as daily settlement price. When we are going to do the final calculation of profit and loss, we are going to take the spot price closing, and this is known as the final settlement price. So here we are having Nifty futures. The date is March 17th. The time is around 9:55 a.m. Here we can see that Nifty futures that are expiring on 29th March are trading at a price of 17,152.95. The previous close was 17,047.30. So as of this particular moment, the Nifty futures are up by 105.65 points compared to the previous day. So around 9:55 a.m., if you want to know what is the price at which Nifty spot market is trading, then you will be able to see it over here. Nifty spot at this particular point is trading at 17,093.35. Around 10:43 a.m. on the same date, Nifty spot is right now trading at a price of 17,072.90. That means the market has come down. And the Nifty futures have also come down. They are trading at 17,131.95. So when the spot price is changing, the Nifty futures is also changing accordingly. So around 3:15 p.m. on the same day, the spot market is right now at 17,105.85. So the market has come up. Nifty futures have also come up, and right now they are almost 141 points up compared to the previous day. Let's see the closing prices. At 3:30, the closing price of futures is 17,189 and the closing spot price was 17,100.05. So compared to the previous day's closing of 17,047.30, today Nifty futures are up by 141.70 points. Let's check the spot market. So 3:30 p.m. the spot market closing price is 17,100.05 and compared to the previous day's close of 16,985.60, today the market is up by 114.45 points. So this is how the payoff diagram for the long futures contract looks like. So let's say they have entered into a contract, or this person has entered into a contract when the price was 100. If the closing price is 110, he is going to make a profit of 10 multiplied by whatever is the quantity. So 10 multiplied by 50, let's say he's going to make a profit of 500, assuming 50 is the lot size. If the closing price was 120, then he's going to make a profit of 20 multiplied by 50, which is going to be 1000. So if the market goes up, he is going to make profits. If the market comes down, he is obviously going to make a loss. So let's say from 100, the market has come down to, let's say, 70. That means it has come down by 30. So 30 multiplied by 50, assuming we are at this point, he is going to lose minus 1,500. This is going to be his loss. So this particular kind of a payoff where we have a straight line, this is known as a symmetric payoff. Symmetric payoff means unlimited profits and unlimited losses. So there is a chance that the party can make unlimited profit, or there is also a chance loss could also be unlimited. So if let's say it is the closing price is 60, he is going to lose minus 40 multiplied by 50, he is going to lose 2000. So profit potential is unlimited, unlimited profits. The loss potential is also unlimited. So the payoff diagram is a straight line. It's a symmetric payoff. Now for the short, if the market comes down, he's going to make profits. So market comes down, he's going to make profits. If the market goes up, he is going to make loss. So let's say he has taken a short position at 100. If the closing price is 80, he is going to make a profit of 20 multiplied by 50, which is, let us say, 1000. On the other hand, if the market goes up to 130, he is going to lose 30 multiplied by 50. That means he is going to lose 1500. Here also the profit potential is unlimited and the loss potential is unlimited. This payoff is also a symmetric payoff. So for him, this is more like a downward sloping curve. If the market goes down, he is going to make profits. If the market goes up, he is going to make a loss. Now we are going to compare forward contract with futures contract. I hope the difference is very clear. So if not, let's compare the points. So first, forward contracts are OTC contracts. So they are not going to be traded on the exchange, and futures contract are going to be traded on the exchange. OTC contracts can be customized. You can decide the price, the quantity, the mode of delivery, how to do the settlement, cash settlement, physical settlement, etc. But you cannot decide those terms in futures contract. These are standardized contracts. The exchange will determine the terms and conditions. In forward contract, the credit or default risk is very high. So either of the parties can default and the counterparty faces the risk. but it can be reduced if there is a guarantor. So let's say if somebody is going to default, some other person is going to make the payment. So the credit and default risk in forward contract is very high. Here, the clearinghouse is going to play the role of a middleman. And because we are doing a daily mark to market, or we are doing a daily calculation of profit and loss, the clearinghouse is going to help reduce the credit risk. So the clearinghouse ensures that none of the parties are going to default because the profit and loss settlement is happening on a daily basis. We have the maintenance margin to take care that no person is going to be negative, or no person is going to keep on going to make a loss and he is going to default. The next point is forward contracts are not traded, so you cannot pass on your position to somebody else. You cannot buy and sell contract on a daily basis, so the liquidity is low. Futures contract, you can buy and sell on a daily basis, very similar to what you do in equity shares. So let's say you buy a futures contract when the price is 100. After half an hour, the price goes to 102. You can sell this futures contract, exit your position, book a profit of 2, multiply by, let's say the lot size is 50. You're making a profit of 100 immediately in half an hour. So you can easily enter and exit into positions because these contracts are traded on the exchange, so the liquidity is high. Now, price discovery is inefficient. Prices are not readily available in the forward contracts. You have to decide on the price at which you have to undertake the contract. But on the other hand, in futures market, the price is set by the market on the forces of demand and supply. So prices are readily available, and price discovery wise, the futures contract is very efficient. In forward contract, the quality and speed of information dissemination is poor because the price discovery is not efficient. We do not know at what prices people are trading, other people are trading into the contract, how many number of forward contracts are existing at any point in time. Because it's an OTC contract, no information is available. So let's say nobody will tell how many forward contracts on Nifty or how many forward contracts on apples, oranges, crude oil is available at one point in time. So quality and speed of information dissemination is poor in OTC markets. But for the futures contract, information is disclosed. The exchange is going to publish the information on what is going to be the closing prices, how many people have taken new positions today, how many people have closed their positions, what is the number of contracts that are actively traded on any one particular exchange, what is the underlying, etc. So information is easily disclosed, it is easily available and disseminated. So any person can go to the NSE stock exchange and find out what is the current prices of Nifty futures, what is the closing prices today, what was the closing price yesterday, how much margin is required, etc.